welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. The Investor in the Mirror. Why human emotions can be our own worst enemy. In investing, the truth often lies behind a veil of simple numbers. The cover story of Mutual Fund Insight May 2025 issue reveals a sobering reality. The gap between what our funds earn and what we, as investors, take home. The figures are stark. Funds achieve 18% returns, while their investors walk away with just 8%. Where does the missing 10% go? Not to hidden fees or market manipulations, but something far more personal. The culprit, it turns out, is staring back at us in the mirror. This performance gap isn't theoretical. It's mathematical, measurable, and meaningful. Over a decade, it translates into lakhs of rupees that could have funded a child's education or served as the down payment on a home. What makes this frustrating is the funds themselves performed as promised. They delivered. We, however, did not allow ourselves to receive. Why do we sabotage our own financial success? The answer lies in how our minds have evolved. We're not designed for the patient discipline that investing requires. Evolution has equipped us with brains that excel at detecting immediate threats and seizing instant opportunities, perfect for surviving in the prehistoric world, but ill-suited for navigating financial markets. Consider recency bias, our tendency to overweight recent experiences. When a fund performs well, we rush towards it, often precisely when it's reaching its peak. When it stumbles, we flee, typically at its bottom. This isn't unique to novice investors. It's a human trait we all share. Our instinct to chase winners and abandon losers is deeply ingrained. We change lanes in traffic jams for the same reason. The constant feeling that someone is moving faster. Our data confirms this pattern. Nearly 40% of investors abandon their funds within 2 years. Barely enough time for compounding to begin its magic. The consequences of this impatience are painfully evident in the gap between investment returns and investor returns table in our cover story, where fund after fund shows significant gaps between what they achieved and what investors received. Herd mentality compounds the problem. There's comfort in moving with the crowd, but financial markets often punish the consensus. Fund inflows spike after extended rallies when prices are high, while investors flee en masse during downturns when bargains abound. Google Trends confirms this pattern. Searches for mutual funds peak near market tops and vanish during dips. This isn't investing. It's a reaction with a delay. What makes this pattern particularly challenging is that it feels entirely rational at the moment. Each decision, abandoning a lagging fund, chasing a hot sector, and retreating to cash during market turbulence seems prudent when made in isolation. Only when it's viewed collectively does the pattern of self-sabotage become clear. The good news is that awareness is the first step towards change. The antidote to these tendencies isn't complex, but requires something harder than complexity: discipline. Investing for the long term, staying invested through market cycles, using SIPs to automate purchases, diversifying thoughtfully, and rebalancing annually rather than emotionally, these principles aren't new, but they work. As our cover story demonstrates, SIPs started even at the worst possible time, right before the 2008 crash, outperformed lump sum investments at market peaks. This isn't because SIPs are magical, but because they protect us from ourselves, helping us buy more units when the market has fallen and fewer when it's expensive. The tug-of-war between strategy and emotion recalls Benjamin Graham's quote. The investor's chief problem, and even his worst enemy, is likely to be himself. Success isn't about spotting multi-baggers or timing the markets, but sticking to a good plan despite doubts. Our cover story of Mutual Fund Insight May 2025 issue isn't a rebuke but a mirror. Knowing our biases won't erase them, but it can help us avoid sabotaging ourselves after we've made the right investment choices.